Hi, everyone. Thanks for joining in today for a conversation I'm extremely excited about. I will be your host today. And as an introduction, I am Shiv Sehgal, Head of Institutional Securities for the Edelweiss Wealth Management franchise. And today we have an immense pleasure of welcoming Dr. Mark Mobius. Not that he needs an introduction, but I would love to give a small brief on him. Dr. Mark Mobius has been synonymous with the emerging markets and frontier markets investing for almost 3 decades and more. He has the reputation as one of the most influential and successful money managers in the emerging markets. In 2018, Mark founded the Mobius Capital Partners, and prior to that, as all of us are aware, he spent more than 3 decades at the Franklin Templeton Investments. Most recently, as its executive chairman of the Templeton Emerging Markets Group. Under his leadership, the group's assets under management went from almost US $100 million to a very impressive $50 billion. He's launched a number of numerous focused funds on Asia, Latin America, Africa, Eastern Europe. Is probably the most well-traveled emerging market fund manager I know of. And he's contributed tremendous to the developing of international policies for emerging markets. He's also served on the World Bank's Global Corporate Governance Forum. He earned his PhD in economics from MIT in 1964. He's won numerous industry awards and has authored a dozen books, including his most recent and timely one, The Inflation Myths and the Wonderful World of Deflation. Some of his books have been translated into several languages, a testament to his global reach and influence. He also shares his experience and knowledge on emerging markets through his frequent media appearances on global networks as Bloomberg, CNBC. I'm sure all of you have followed him on many snippets in YouTube. Today, as I mentioned, we have the privilege of hosting him on Edelweiss Wealth franchise. And with that, at the very outset, I would like to invite and thank Mark for his time today. Mark, a very warm welcome to you.
Thank you very much. It's nice to be with you and all the team at Edelweiss.
Thanks, Mark. So, we have a tremendous amount of enthusiasm coming from, everyone joining in. I would like to begin by saying that, you have been called the godfather of emerging markets, the Indiana Jones of emerging markets. And very recently, I read in the Financial Times referring you as the Michael Jordan of EMs. So let me begin by asking you why emerging markets. I'm going to start from the very beginning, how these markets attracted you at the very outset. Would love to hear something about your early days of investing and, how much the landscape has changed in the years and, where we stand today.
Well, it can best be summarized in one word: growth. The growth of emerging markets have consistently outpaced the growth in GDP terms of the developed countries. And of course, when we started in 1987 with the very first emerging markets fund, listed on the New York Stock Exchange, by the way, there were only 5 markets in which we could invest: Hong Kong, Philippines, Malaysia, Thailand, and Mexico. That was it. All these other countries were closed for one reason or another. They had socialist governments or communist governments. They didn't really welcome foreign investment. And then the World Bank and the IFC, to give them credit, promoted the idea that in order to grow, because the whole question of growth was on the minds of professors. I remember at MIT, my professors were focused on trying to figure out how countries grow. And everybody finally came to the conclusion that you have to have a market economy in order to grow. And a market economy means a stock market, a market where stocks can be bought and sold. And as you know, this idea spread throughout the world, and even in the so-called communist countries, China, Russia, and other countries, they adopted and embraced the idea of a market economy, even though they didn't embrace the idea of a democratic society, but they did embrace the market economy idea. So after that beginning in 1987, the number of countries expanded dramatically. And eventually we were having offices in all over the world. We had offices all over Asia, of course in India, we had an office in Mumbai, in Eastern Europe, and of course Russia opened up. That was a big boom. China opened up, and of course a lot of the African countries joined in, as well as Latin America. So it's been really an exciting ride, and the premise of growth is still alive and well. In other words, these countries that are so-called, they were called underdeveloped or less developed. Now they're called emerging markets. In fact, tend to grow faster for a number of reasons. First, they're starting from a very low base. And secondly, because they have a young population. A good example is India. I think the average age in India is what, 26? Average age in China is 36 or something like that. Average age in America is probably even higher than that. So we have a young population and a growth prospect, which is very exciting.
Perfect. Thanks, Mark. Very insightful. Mark, as I look at it today, we are in March 2022. Exactly 2 years back around this time, India was going into the most stringent lockdown, compared to, at least in most of the EMs. We have had 2 years of very interesting times. We had the global pandemic, we have had the economic crisis to go along with it, and we have had a very, fructious financial markets and the pumping of, central banks and liquidity. But as we look at 2022, it's been a very eventful start to the year. We have got the ongoing geopolitical crisis in Europe that has led to the increase in short-term volatility. That's impacting global prices, global commodity prices in particular. As of last week, we had the first Fed hike. They've been talking about it, and it's probably the most anticipated and most, priced-in Fed hike ever that I've seen. And do you think, as we stand today, that the Fed will be able to, given the macro backdrop that we are looking at, and global growth is actually slowing down, given what's transpired with China and Russia, do you think that the Fed will be able to walk the talk of further rate hikes? And more importantly, from an emerging market perspective, how do you see that, in terms of should investors care, or the fact that, we are at, as you said, from such a low base of interest rates, that a few hikes will not what hurt, and actually a normalization of policy is very much required. And just getting your insights as to how you see the macro backdrop of the Fed and some other central banks raising hikes, and how that impacts emerging markets in India in particular would be great.
Well, there's no question in my mind that the Fed will continue to increase interest rates. As I point in my book, the problem is that the Fed and all the other central banks look at the CPI, the Consumer Price Index, as a guide as to what action they should take. And very often the action they take is just the opposite of what the economy needs. When the economy is booming, that's when you want interest rates to be higher. When the economy is headed for a downturn, you want to lower interest rates, but that's not what they do. They keep on raising. So there's no question that according to the playbook, the Federal Reserve playbook, you have inflation now. The CPI is running at what, 7% or even higher? That means they've got to raise interest rates above that, because their thinking is that in order to beat inflation, you've got to have a real interest rate. That is an interest rate which is above the rate of inflation as it's measured by the CPI. Of course, all of this is a very bad formula, but it's what we're going to be faced with. Now, when you have a higher interest rate, does that mean the stock market crashes? No. If you look at history, there really is no correlation between interest rates and what the stock market does. And of course, the reason for that is that if you have good companies who are able to adjust their prices with the higher costs, then they do very well. So you have a situation which we're now facing, is that all those companies with heavy debts, those that don't have pricing power, will be in trouble. Those that have no debt or very little debt and high pricing power will do very well. So you're going to have winners and losers. And overall, it's very important, therefore, in this kind of environment for investors to be in equities, one way or the other. Now, it doesn't mean that you put everything into equities right now, but you keep a little cash on the sidelines, maybe 10, 15%. But otherwise, you should really be invested in those companies I just mentioned.
Thanks, Mark. Mark, you've been recently quoted as, I read one of your interviews, and you said India is on a 50-year rally, right? We at Edelweiss have been very bullish from the domestic story here in India as well. So that's clearly music to my ears and the franchise. But I would love to dwell on the factors why you thought that we can see a sustained bull market rally in India and your rationale of being invested in the Indian equities from that standpoint?
Well, there's no question. Along the way, there will be bear markets. There will be downturns. That goes with the territory. If you're in equities, you got to be willing to withstand these downturns. But what we've learned over the years, not only in India, but in other markets around the world, is that bear markets are very short in duration, usually no more than 1 year. And by the way, a lot of people measure bear markets the wrong way. They measure it from the previous peak to the next peak. That's not a measure of bear market. The bear market measure is from the peak to the bottom. When you're at the bottom, the bull market begins. And that period from the peak to the bottom is usually 1 year or less. Then you have an incredible opportunity upside. I don't know whether you've been looking at the Chinese market. Alibaba, who's had a tremendous downturn in their stock price, is up, I think, probably about 30% or more from the bottom. So when you're at the bottom, you can get tremendous returns when you get in at that low level. So what I'm saying to people is that, look, don't be afraid to be invested. Yeah, the next day the price may go down. You may be suffering a bear market for a half year, a year, even a year, but that's not the end of the world. It's time to buy more. If you're really convinced that the company is a good company, good earnings capability, good pricing power, no debt or little debt, then you're in pretty good hands.
So Mark, just carrying on that, you mentioned a few criterias on good companies, right? In your wisdom over the last couple of years, are there any particular criterias or a subset of financial metrics that you look at when investing in companies from an emerging market perspective? And I would caveat that by saying that, how do you think that India differs from other EM countries when you look at companies in India? Like, some insights there would be lovely.
Well, what we look at, first of all, is return on equity, return on capital, return on invested capital. Those are very, very good measures to get an idea of how a company is going to survive going forward. Interestingly enough, companies with a very high ROC, ROIC, ROE tend to have low or even no debt. And the reason is very simple. If they're having a very good return on capital, they don't need debt. They can finance themselves. The next thing, of course, you have to look at earnings per share growth. That is a real key measure, along with others. But I would say return on equity is very much related to earnings per share growth. And that's what we want to look at. And the third thing you want to look at is debt, of course. Companies with over 50% debt equity, usually you got to be careful. You don't want to get involved. So those are just three simple criteria, because we look at many, many other criteria. One very important point is that many people tend to look at price earnings ratio. The problem with price earnings ratio is that it's a backward looking measure. Okay, you can make a projection of what the earnings may be and say, okay, I think the PE will be this going forward. But more than not, most analysts look at the PE ratio based on the previous year's earnings, the E of the PE. And that can be very misleading, because if a company is growing rapidly, high return on capital, that PE can come down very, very quickly in the future. So PE is still a good measure, but it's not the end of the analysis at the end of the day. The other measure that people look at is price to book value. And again, with software, with the internet, with so much of a company's assets walks out the door every day, so to speak, because you got brain power. That's the key to a company's success. The book value, as measured by things like offices, furniture, et cetera, is not a very good measure.
Perfect. Thanks, Mark. Mark, one more quote of yours, and I use this extensively when I'm talking about, the India-China comparison. You mentioned that India is maybe where China used to be 10 years ago. And, even in our own research and Edelweiss, on the consumption patterns, on the demographic patterns, you also alluded to the fact that, the average in India is 26 versus China in 36. So, the India-China comparison is an interesting one, given the relative size and the stages of development both the nations are. How do you see your allocations between India and China changing going forward? And the reason I'm asking that is, given the recent regulatory crackdown in China over the last, a year and a half, do you think India becomes a more and more compelling investment case for EMs as a longer term perspective, or do you think that given the carnage in India or China recently, that there is some merit in putting a valuation rally in China in the near term? Just some thoughts there would be great.
Well, if you look at our own portfolio, you'll see that India is much bigger than China in terms of weighting. In fact, Taiwan and India are the biggest weightings, and China is like fourth or fifth in terms of weight. So that tells you something. In other words, we're finding more opportunities in India. That does not mean that we're going to ignore China, because China's got an incredible market size, very high market liquidity, and many companies that are doing quite well that we want to be involved in. The problem now facing China is really a combination of things. First of all, as you know, the domestic investors has not done very well. The property market has crashed, and you must remember that the Chinese market is driven by domestic investors, not foreign investors. So that's one downside. Of course, the government could step in and say, look, we support the market. And usually when they do that, everybody piles in. But we haven't seen that yet. Number two, a lot of the other companies are heavily in debt, a lot of leverage. Number three, the US, of course, has begun to crack down on Chinese companies that don't reveal their full set of accounts according to American standards. And some of the ADRs have been under delisting. So This is all negative. And then the third problem, of course, is Russia. I mean, the concern that if China openly and aggressively assists Russia in Ukraine, then the Americans and other countries may impose sanctions. That's probably a little far-fetched, unlikely, but it is a fear that people have. So all these things are sort of weighing on the Chinese market. Doesn't mean there are not any opportunities. There certainly are, but we are certainly continuing to look at China. But right now, India is at the top of the list.
Perfect. Mark, another stat that's come up, right, especially in the last 6 months, is that we have seen a lot of foreign portfolios. The net foreign flow from India in the last 6 months has actually been on the outflow. The number is actually close to $20 billion that we have seen foreign institutions sell India. And that started in October of last year, and that's continued into this year. And the flip side of that is, there has been a tremendous amount of demand from the domestic investor flows, and they've been able to offset this outflow and supply. And, historically, what we have seen is that, a 20 billion outflow in India, if I compare that to the global financial crisis and other, as you said, the pullbacks and the snapbacks in emerging markets are much more sharper. This time around, the outflow has been stemmed with the fact that we have seen so much demand from the domestic retail and domestic institutions. But there is a bit of a tug of war going on, right? Either the foreigners are right and earnings will not come up in the next 1 or 2 quarters, or there's a geopolitical element here that we have seen the passive funds, which are getting, especially the emerging market funds getting redemptions, are not being able to sell their shares in Russia. And a majority of that is coming into markets like India and Korea and Taiwan, which are seeing some outflow. Do you feel, should there be, we don't know how the peace treaty will play out between Russia and Ukraine. It could be today, it could be 2 weeks down the line, it could be a month down the line. But do you feel, as you alluded to the earlier conversation, that any sharp drawdowns in India are still to be bought into? So buy the dips. And the other element I would try to ask you is that, do you feel that this year is unlike the last 2 years that we have seen, where the market just trended in a buy and hold strategy, whereas given the volatility is back this year, we see a little bit of the trading mentality coming back from hedge funds, and as such, active fund managers play a much more, alpha role than what passive funds have in the past, especially in the past 2, 3 years?
Yeah, I mean, the point that you make about the passive funds is very well taken because at the end of the day, I would guess that about half of all major investors, I'm talking about those billion-dollar trusts and funds, half of their investing in emerging markets, if not all, is indexed. In other words, they're buying ETFs, exchange traded funds. And those indexes are based on, could be the MSCI, S&P, whatever index, with a heavy weighting in China. China represents maybe 30% of the index. So given the fact that the Chinese market has crashed severely, the emerging markets index has also crashed. And therefore, these people that are holding the ETFs must get out. They're forced to sell. And that means not only China, but India, well, of course, Russia, you mentioned, is out of the picture. Brazil, all these countries would get hit with redemptions from these major institutional players. Now, yes, it's a good idea to look at the dips coming in as a result of that, maybe find some bargains in India and other countries. But that's really the name of the game now. You have to be very aware of the fact that so much of the investing is index investing, which means that the active investor is in a very good position. And that's the reason, by the way, we started our fund. We said, look, we don't want to be indexing. And, when you get to a certain size, it's very difficult not to be indexing because the index is based on the market capitalization and size of the companies. And if you're running $1 billion fund or a $2 billion fund, you're more or less difficult to escape the index stocks. So that's the reason why we're running a very active fund and a fund that is diametrically opposite to any index.
Perfect. Mark, also there's a constant debate in the global macro circles and even in India, right, about the USD as the global reserve currency under threat. Also, this accompanied with, the sanctions imposed on Russia, on the Russian reserves. And, yesterday Russia came out and said that they'll sell the European gas in rubles. Will it make other central banks move away from the USD? I think the question that I have for you is global reserve currency system under risk as the US dollar? And I guess the bigger question is, what are other alternatives to USD currently exist? Because there are none. Any thoughts or insights there, and how you see that, the global debate going on from the macro world there?
Well, you must answer the question, why is the US dollar so popular around the world? And the simple answer is that it's freely traded. It's very easy to deal in US dollars around the world. I'm here in Dubai, I could go on the street and buy something with dollars and people would accept it. So, and I'm sure that's true in India as well. So this is a very, very important point because yes, the Chinese renminbi could become a reserve currency if, the big if, the Chinese government allowed it to be freely traded. But they don't want that. They want to control the exchange rate, particularly against the US dollar for obvious reasons. So you have that true of central banks around the world. Probably the only alternative would be the euro. And the euro, however, has not done very well recently. If you notice, it's gotten significantly weaker against the US dollar. Of course, no surprise with Russia ready to take over all of Europe. People want to get their money out. But I find it very difficult to think of an alternative to the US dollar in terms of trade, in terms of investment and so forth. It's a very popular currency, at least at this stage of the game. And I think it will remain so. And of course, now with interest rates going up, it may even become even more popular because people will be able to hold dollars and get a good return. One of the problems with the euro, of course, has been that with zero or negative interest rates in Europe, the people didn't make any sense to hold on to euro. They went into cryptocurrencies. One of the reasons why cryptocurrencies are so popular is because we've had an era where interest rates have been below 1 and even negative. So it didn't make sense for anybody to hold these currencies, even the US dollar. But now that's changing.
So I'll, question back to you on crypto, right? I mean, it's a digital asset class that's actually, done really well in India in the last 2 years. As of now, I was reading a stat that there are almost 20 million crypto accounts open in India. Of course, the scale and the size and the notional is a lot smaller than developed markets. But one can't ignore the dramatic growth that it's seeing and the adoption that it's seeing in the world over. Do you think, in your vision, in the next 5-10 years, that it is an asset class that will do very well, given the small scale it exists today, or do you think it's a fad that goes away? Like, just some insights there would be lovely as well.
I don't think that the cryptocurrencies will do well going forward. For one reason that I just mentioned, interest rates going up, it will become less and less attractive to hang on to cryptocurrencies because the cryptocurrencies, as far as I know, don't earn interest. Now, I know some of the crypto exchanges do offer some kind of interest on deposits of US dollars, interestingly enough, but not in the crypto itself. The other thing you've got to realize is that more and more governments around the world, including India, as you know, have banned cryptocurrencies. Of course, people are still going to trade in it regardless, but it'll be more and more difficult given government restrictions. And thirdly, you must realize that cryptocurrency prices are determined by only one thing, and that is the sentiment about cryptocurrencies. If you buy a stock, yes, the price is determined by who is buying and who's selling, but at the end of the day, the company makes earnings and they pay dividends, et cetera, et cetera. Crypto doesn't do that. So I think my guess is that crypto is going to head into trouble going forward.
Fair enough. Mark, emerging markets, when I look at the last, probably this century, last 22 years, we had a phenomenal run in emerging markets from 2003 to probably the global financial crisis. And then, 2010 onwards, it was, it's been more about the FANGs and the S&Ps and the NASDAQ doing really well. But with commodities bouncing back, whether it is geopolitical reasons or inflation, do you think that this could be the decade of EMs? But the problem I struggle with that statement is that we have two large emerging markets, which is Brazil and Russia, and maybe if I can put China in that bucket from a small extent as well, not performing to the level that people would want or the confidence in large scale, institutional asset allocations. And do you think, as you alluded to as well, that, it's India and Taiwan that are the two biggest portfolios in your capital asset allocation as well, that we see a theme back to dedicated funds in EMs? For example, like, do you see most of this flow that comes into EMs coming into India, Taiwan, Vietnam? Do you think that EM as an asset class is broken at the moment, but it's more about, finding the jewels in the crown in EMs, and, that's where the bulk of the money flows to? Is that how you see it in the next couple of years, especially for this decade?
Yeah, I think it's, as we mentioned earlier, the idea of being an active investor is going to become more and more important in emerging markets. In the past, as you know, in the first decade, 2 decades of emerging markets, everything was great in emerging markets and you didn't have to worry and buy an index. And now the world has gotten a lot more complicated. As you mentioned, China's in trouble, Russia's in trouble. Actually, Brazil is doing pretty well, but again, Brazil is kind of an iffy situation. They do get into problems from time to time. So it's going to be a more active market at the end of the day. The other thing that's made things a little more complicated is that the definition of what is an emerging market stock is becoming very difficult. So, for example, if you look at the US market and look at the top performing companies, what percent of their earnings are from emerging markets? What percent of their staff are from emerging markets? So we've seen an opening up of the world, so to speak, where companies in America have taken advantage of the growth of emerging markets and have, in fact, themselves become emerging market companies, if you know what I mean, because more than 50% of their earnings, their staff, and so forth are in emerging markets. The other fact, of course, is that you look at Silicon Valley, they've been using a lot of emerging market staff, people from emerging markets, to run these companies. I mean, how many Indians are now running Silicon Valley companies and doing very well? So this is another factor that's complicated the definition of, what is an emerging market?
No, that's very interesting point. I completely agree with you there on the US companies and some of the largest companies in the world driving bulk of the resources and both technical and and the people resources from emerging markets. So Mark, just from an India specific standpoint again, we are likely to expand from a 3 trillion economy to a 6 trillion economy in the next 6-7 years in India, right? One of the key questions I think everyone joining in from the audience would also want to hear which segments in your mind, whether it's the financials or the tech, when you look at India, which are the segments that will drive this growth and which are the segments that you think are the most bullish within the India theme in the next couple of years?
Well, the obvious ones have to do with technology. In other words, companies that are doing software engineering, companies that are even hardware, more and more manufacturing of hardware, of computer hardware, technological hardware will be in India. And in the medical area, medical testing, hospitals, clinics, all those will be big growth areas for India. So those are two areas which I think deserve a lot of attention. But at the end of the day, you have to broaden the scope to look at all sectors of the economy, whether it be appliances, fast foods, whatever, but focus on whether the companies in those sectors are using technology to the best advantage. Because the companies that are able to utilize technology will be the survivors. They will be the ones that do well. So regardless of what sector you're looking at, you have to first look at how they're using technology and whether they're using it to enhance their earnings growth and their productivity.
Perfect. Thanks, Mark. I would, at this stage, love the audience to put in some questions as well. While I'm really enjoying this conversation with Mark, I do want to give this opportunity to people dialing in and enjoying this conversation. We do have a live chat bot, so you please feel free to put your questions there, and I'll sniff through them and ask the most relevant ones to Mark, time permitting. On that note, I'll move on to the next question, Mark. We talked about geopolitics and the fact that if China were to take a stand on Russia, that they could see some sanctions there, and we have seen maybe not a polarization or a depolarization of countries probably providing I guess the support to Russia, but India has taken a very neutral stand. We have historically always been a peace-loving nation, and we generally avoid conflict. But do you think, with the view on these recent developments, that there's an acceleration to the deglobalization process that we saw in the last decade? It was all about globalization, as you also alluded to. Most of the global companies, whether it was using supply chains, or exporting deflation from labor in China, or getting the raw materials from Southeast Asian nations, to a world where we now are looking at isolation, and we are also looking at, kind of a supply chain logistic and kind of securing supply both from raw material and resources. Do you think there's a tectonic shift in most of the nations, or do you think this is a blip that just tides over? And what are the implications from an investment perspective regarding that?
It's really a blip. I don't see we can even conceive of deglobalization. It's just not going to work, because the communications between people is becoming faster and more comprehensive. The fact that we can talk to each other like this at a very low cost is an example of what you can do. And this is happening globally. So We definitely are not moving into deglobalization. In fact, we're accelerating globalization. Now, of course, there'll be supply chain changes. That's obvious, but it will be impossible for companies and countries to depend on themselves for everything they want to do. You know, I'm here in Dubai, and yesterday I went to the expo, and it was interesting. They have a centerpiece, which is a huge dome, and I was talking to the architect about this dome. He said, you know, we had 15 countries participate in the construction of this dome because we didn't find one country or one company that could have all the technology required to do this. So this is an example of globalization on a big scale. And I think this is going to continue.
Fair enough. I'm going to ask you an audience question that just come in, Mark. One of our joinees has asked, you know, equity investing has seen a significant flavor amongst domestic participants in India in the last 2 years. And, you know, there's been a huge offtake of demat accounts in India. While this is also a trend globally where share of retail investors has increased, especially with the Robinhoods in the US. What is the long-term impact in your EM experience in other countries of the larger domestic participation in Indian equities? So the question, I guess, you know, the audience is asking is, India has always been a capital-starved nation, right? But we have seen an inflection point where, you know, domestic money is now coming in a very meaningful manner. How has your experiences with other EMs that transition or have done well, and how important is this shift that we are seeing in India today?
That's a very, very good point. I think a very good question. I found that, and a good example, by the way, is India. The participation of the domestic investors is a very vital part because, as you just mentioned, foreign investors going out, domestic investors going in, which evens out the volatility, reduces the volatility of the market. In China is another great example. When we started investing in China, there were no domestic investors to speak of. Now, the domestic investors really rule the market. They're the ones that really drive the market. So it's a very, very critical area and a very nice thing to see because it means that more and more people around the world are participating in the market economy in a very dramatic way, which is very good because it moves more and more towards what George Soros calls an open society. I think it's a very good development, and I think going forward it'll become more and more important.
Well said. Mark, I have a very specific question here on one of the sectors in India. You know, we have been seeing a revival in real estate in India, which has probably been in a consolidation phase since the 2010. So, you know, 10, 12 years of consolidation. While there were pockets, you know, in some tier cities that did well. But do you think, the question that the audience is asking is, do you think in India we are at the cusp of a big real estate upcycle here? Any thoughts or insights there from your end?
Well, there's no question. If you look at the potential demand, actually not only potential, but actually current demand for housing, for all kinds of real estate, the demand is there and growing. As per capita incomes go up in India, there's going to be more and more demand for housing and that sort of thing. The problem, of course, is a regulatory one. In other words, we've got to have an environment whereby the title to a property is secure. We've got to have an environment where developers cannot take a big deposit and then run away and that sort of thing. So this kind of regulatory environment is very, very important for the industry. And I think, of course, India has moved in a strong direction to correct some of these problems we've had in the past, but still more has to be done. If it is done, then the real estate sector will do very, very well. It's already potentially a growth area, but it'll become even more of a growth area with these kinds of reforms.
Perfect, thanks. I have another question here, and this is probably on you know, given the bullish statements that we have made. The audience is asking, from a global macro perspective, India is actually facing a number of headwinds in the short term as we see commodity rally and the crude prices being at elevated levels. And given that India is a net importer, it does have a negative impact on India, which we are all aware of. And also the fact that Federal Reserve is also on a sustained path of tightening monetary policy. What are your main risks that you foresee for India in the near term, apart from commodity inflation? So I guess the question here is, what are the headwinds that India could potentially see in its bullish stance?
Well, I think one big potential headwind would be a reduction by the government in the number of listings they want to do of government entities, government institutions, and companies. Because if the government is able to continue listing of government enterprises, the market will expand quite dramatically, and it will attract more and more investors around the world. So I think that's one headwind we have to look at. Any pullback by the government in this policy to privatize more and more state-owned enterprises. The other area, of course, is any pullback in terms of the application of technology, not only to private enterprises, but to government operations. And of course, Modi has done a terrific job in introducing more and more technology to reach into the villages of India, because at the end of the day, India is still very much a village-oriented country, an agricultural-oriented country. And so the degree to which the government and enterprises can reach into these areas with technology, which they're doing, as you know, this will be very exciting. But any pullback from that will be negative.
Mark, I'm just seeing the chat box, and I have at least 4 or 5 people, on the outset have asked, what is your view on gold considering a 3-year horizon? And I think gold is a favorite among Indians, as you know. Would love to hear your thoughts there as well.
I think it's very important to have some gold. I recommend maybe 10% in gold, and just, physical gold, you take it and you lock it away. And of course, Indians have been doing that for generations, and it's served them very well, as you know. In times of trouble, it's good to have gold. So yes, I believe in gold, but most of the portfolio should be in equities.
I have Sanjay asking us a very interesting question, which I thought I want to highlight. There was a trend in the past to invest in frontier markets. Do you think that is over, or do you think, emerging markets like India will be the only flow, or like countries like Taiwan, because we don't see much coming from frontier markets or being talked about in the press in the recent past? Any thoughts there?
Yeah. Well, no question, the frontier markets will be alive and well going forward, and will get bigger. The problem, of course, is that some of these countries are very small. The turnover of the stock markets are too small for most investors from overseas, unless they're running very, very small funds. But we have, for example, an investment in Kenya, which is considered a frontier market, and it's doing very, very well. So I would not give up on frontier markets. The potential for frontier markets is still very great. And these countries, as they adopt more and more technology, there'll be opportunities. Don't forget, Vietnam used to be considered a frontier market. I don't know whether it still is. And it's become quite an important market.
Absolutely. No, absolutely. Couldn't agree more. Mark, also, I'm just seeing a lot of comments coming on your thoughts on ESG. I think people have seen you speak on prier interviews on that. Just some insights there as well.
Well, we consider ESG critical to evaluating a company. In fact, I should have mentioned that in addition to the financial factors, every company in which we invest, we evaluate the environmental, social, and governance factors, mainly because you want to reduce risk. If you have an environmental risk, it's a problem. If you have a social risk, it's a problem. If you have a governance that's not good, you have risk. But we've added one more thing to that, and that is C, the culture. The culture of the company we found to be critical in order to achieve a good ESG score. So we then look at the culture of companies, and that is things like what's the morale of the staff? How do they feel about the management? Do they feel they're being listened to? And so forth. This is very important.
Mark, this is a very interesting question, and I think I would love to have asked you this. And I'm going to quote him. So it says, Mark, I have been following your views for many, many years, and I've learned a great deal from your books and insights, but I'm equally impressed that you never age. What is the secret to your health?
We do age. There's no question about that. I think the number one, of course, is exercise. You've got to exercise on a daily basis. I know many people say, oh, I don't have time for exercise. No, that's not an excuse because you can take a half hour a day, and it's very important to exercise, number one. Number two, one thing that I'm not very good at, and that is watching my diet. I do like sweets from time to time, but it's a good idea to reduce the intake of food generally. The third thing, of course, is to be active. You know, people ask me, when are you going to retire? And I say, what does that mean? What is retirement? I don't know that word. It's not a good idea to retire. You should always be active because an active brain, of course, tends to impact your body. So I think a combination of these things is very important.
Perfect. Mark, thanks so much for your lovely insights and thoughts. It's been an absolute pleasure for me to host this, and there are surely interesting times coming in 2022. And I wish you and everyone joining in the very best in investing and health. And any closing remarks from your side, most welcome.
Well, all I want to say is be optimistic. The world may look very, very bad out there. You may pick up the newspaper every day and wonder what's going on and be very worried, but don't worry. Be optimistic. Think of the future. The future looks very bright. As I point out in my book, we're in the wonderful world of deflation. In other words, because of technology, things are getting better and they're getting cheaper in real terms. So keep your chin up is the term we like to use.
Perfect. Thanks, Mark. Lovely having you, and wishing everyone joining in thanks as well. I wish we had more time, but we shall have you back soon on the Edelweiss franchise. And thank you so much for your being gracious with time for us.
Thank you. Bye-bye.
Thank you. Thanks everyone joining in. Thank you.